festive season, a lot of the packages that came to my house had the delivery branding on those e-commerce boxes. So of all the new age companies, this is the one that fascinates me the most, because with so much business, why is it that they're not turning profits yet? When they do and how they plan to find out that, I came down to their recently expanded facility in Bhiwandi, and we'll have a conversation with the co-founder, CEO and MD, Sahil Barua. Let's go. Hey Sahil.
Hi Mangalam.
We're talking about a time when we've just come off the festive season, so to say. You had told the exchanges that, you did around 70 million parcels
Right.
in the express business in October itself. But towards the end of November, how does the third quarter look for you?
The third quarter is always usually the peak quarter for us in e-commerce, and what happens in this quarter is a lot of new people start shopping for the first time. And so in some senses, the Diwali and the festive season sets the benchmark for the next year. So like every year, we've seen pretty large offtake across categories. Overall, e-commerce has done well. So we've had a positive third quarter, and we think this sets a good sort of base for the next financial year as well.
So peak to peak, the GMV growth in the e-commerce industry was close to around 15% odd. You guys would have grown faster than that?
I think we've grown a little faster than that.
Perfect. Let's walk and talk. Sure.
These go up the belt, and it's completely automated in terms of it'll scan the box, it'll figure out exactly where this box is going to. We have a routing system which then decides what truck this goes to. And just like you have inbound docks here, you've got outbound docks on the other side. Now, the beauty of this facility is some of these boxes obviously will need manual handling. But for example, some of the smaller ones or the bags, if there's a truck waiting for them at the opposite end, it will just go straight through the automation, straight onto that truck which is waiting for them and ready to move out.
You still have majority of your business, over 60% coming in from express, another 18-20% coming in from part truckload. From the business verticals that you have, what is the margin difference between each, and do you see this mix changing at some point?
Yeah, look, if you look at it, part truckload 4 years back was practically 0% of our business. Today, it's already about 18% of our business by revenue. In terms of tonnage though, in terms of the weight that we carry, part truck actually today is nearly 65% of the overall tonnage that the network carries. So it's a larger business from a weight handle standpoint. The difference, of course, is express is more expensive. So which is why our revenues on the express side are larger than part truck. Going forward, our view is, of course, that while e-commerce and express will remain an important and very, very important part of our business, part truck and full truck and warehousing and supply chain are really where the broader opportunity in a country like India is. More manufacturing, more factories, more part truckload shipping, more full truckload shipping. So we're very bullish on the PTL business and it becoming larger. In terms of margins, given that we run a combined network, for us, both express and PTL margins will look very similar with time.
Which is in the broad range of?
As we get larger, our expectation, the typical LTL companies in India will make, EBITDA margins which are close to about, let's call it 15-16%. So that's sort of normative for PTL business. And our view on both of our businesses eventually is that given our efficiencies, we'll make more than that going forward.
And that brings me to the question, at what level do you get the efficiency? Because I was looking at your data over the last 5 years or so, the amount that you've invested, the cash flow from investment has been close to 8,000 odd crores. And of which nearly 80% has happened in just the last 2 years. So the question is, at what point does it translate into economies of scale, and when do you start enjoying positive margins?
Sure. See, I think first of all, when you look at the overall cash that we've invested over the last 8 years, a significant portion of that has also been towards the acquisitions that we made, Spot-On being one of them. Capital investments, of course, is the other, like this facility. In terms of the part truck business, I think our view is that we will continue to invest. Typically, our capex to revenue ratios right now are in sort of the 7% kind of range.
Yep.
Our view is that over the long term, this drops to about 4%. So it will take us about 3 or 4 years to get there. This, for instance, is sort of a high capex intensity project that we've done. We have one coming up in Bangalore next year. But after that, we're sort of well positioned in the 3 major cities, and that's when capex intensity overall starts dying down for our business. In terms of the margins, I think if you look at our parcel business, now we don't report split up profits overall across our business, but our parcel business has been at its target economics actually for quite some time. It's the LTL business where we've been investing over time to make sure we have these facilities to cater to growth. So I think it'll take us some time. The important thing, or the way we look at it, is that the opportunity in India is so massive that to not invest at this point in time actually would be criminal failure. India needs these kinds of projects. It needs this kind of scale, this kind of investment in logistics, in trucking, for instance, which is another area that we're investing in. So we'll continue to invest for the near to mid-term.
But intuitively, then my mind goes out to a lot of the other players that are in this space itself. They are doing their capex, etc. as well. What is it that they've done differently for them to make the EBITDA margins that they are making, or what is it that you're front loading for you to forego those margin expansions? What is the difference there?
I think the difference is sort of what your investment horizon is. Typically in India, what's happened in the past is people have invested with a relatively narrow view in terms of growth, right? So if you look at even part truckload companies over the last 5-6 years, growth has been relatively slow. Part of the reason for that was regulatorily it was difficult for part truckload companies to grow without GST. But the second also is, at the end of the day, they found it difficult to shift share away from unorganized players towards organized players. Now our view is we're at this inflection point in the Indian economy. Unorganized is shifting towards organized players. You have better infrastructure. Better road infrastructure allows me to drive bigger trailers, right? Which is an area that Delhivery has been investing in. So I think in terms of how people have played this in the past, their mindset has been somewhat constrained by the realities of the market they were in. What we see is a growing economy, a growing manufacturing base, a growing demand for our services, a move towards organized players. And so we've taken a longer view of the world and said, it's important for us to invest in these facilities. I guess that's the only difference. Eventually, if you look at it, some of our competitors have started buying these systems. So I suppose that in some sense validates what we're doing.
I was listening into your conference call post your second quarter earnings, and you said that the company that you're making right now will be the company that you're making for FY27. What exactly does Delhivery in FY27 look like when I look at the company's capabilities of parcel handling, revenue generation, margins, and say profits?
So I think the delivery of FY27 to begin with, our conservative estimates in the next 4 years is that we should be hopefully at least, several times the size that we are today from a revenue standpoint. On e-commerce, it's pretty simple. We've stated it, we believe the lowest cost network. We believe that we service every pin code in the country. So we will, at the bare minimum, maintain market share or grow market share in that segment. Now, it depends on how fast e-commerce grows. Long term, people say 20%, 18%, whatever it is. I think delivery will grow that fast or faster. That's one. On the part truck side, I think the opportunity in India is massive. The industry is maybe call it 5-6 billion in size. Globally, in every market around the world, the top 5 players form 60-70% of the market. India, the top 5 players form less than 10%. Right? So we'd like to be as a starting point, maybe 8-10% of the part truckload market in India, which is 600-700 million in revenue size. And then our other businesses are more ancillary businesses that kind of support or are value additions to our transportation business. So we don't set hard targets for them. So I'd say, we'll be a multiple of our current size, leaders in express, leaders in part truckload. That's our ambition. From a profitability standpoint, as I mentioned, we expect capex to tail off over the next year. So our margins will start looking more like our long-term margins, hopefully in 2 years or so.
All right, that sounds interesting. There is a lot to talk and there is a lot to see as well. So let's walk. Wow, so this looks like a toy factory where things are just sorting themselves out, going everywhere. These robotic. How automated are you versus everyone else in the industry?
I think people have different levels of automation. In terms of hardware, parcel sorters aren't new technology. Conveyor belts are not new technology per se. What separates us is the way this integrates with how we actually orchestrate the network. So it's the software automation and not just the hardware that makes a difference. For example, every package here, ultimately when it gets bagged, there's software which guides exactly where that bag will go, what truck it goes on to, the sequence in which it gets loaded. And that's where I believe, we're significantly different from other players in this industry. And the other, of course, is the fact that we don't follow a traditional hub and spoke model. So the magic's really not as much in the hardware, or not so much just in the physical automation, but also in the way the automation interacts with the software and how we make decisions.
So if you had to define your moat versus everyone else in the industry?
I think our moat is that we use technology to make complex logistics decisions better than most players in this industry. That is really our moat.
And you spoke about the market share in e-commerce. I remember the last time it was a little around 21-22 odd %. That's about the entire industry. But in e-commerce, which is non-captive, what would your market share then be, given your low cost?
Based on the data that we have, our view is that in the non-captive segment, our market share will be anywhere from 40 to 50% overall. And when we look at it even at a customer level, typically customers give us anywhere from half of their shipping all the way up to there are customers who give us 100% of their shipping. So I'd say conservatively probably 45-50%.
45 to 50%. Does that make it lucrative for others to enter this business, or does it make it difficult for others to enter this business given that your market share is such?
Starting a logistics company is easy, right? I mean, if you have a bike, you're a logistics company. Scaling a logistics company and making a national network is hard. So I think it's difficult to compete with us because the economies of scale are baked in. And not just us, to be fair. Any logistics company, whether it's us or it's Blue Dart or whoever it is, the fact is we have economies of scale baked in from years of knowledge, investment in these facilities and automation. We have cost advantages that are difficult to replicate if you're starting out or a small scale. So I think our 45% market share is not exactly attractive unless you have extremely deep pockets and a very long time horizon. So I think it's not an easily competitive space.
So what would you say is your competition? Would it be large national logistics players because of the scale that they have and the reach that they have? Or would it be local players in specific geographies who may have cost advantages of that specific geography? How do you define that?
I think in India, there's no question. The big competition for all of us who are in the organized sector is the unorganized sector. It's a market where still 90% of logistics outside of parcel is done by unorganized players. And so the real competition is figuring out how to provide the same quality of service, the same personalized quality of service that many of them can, to all of our clients. It's in acquiring these clients, letting them know that we're there. So our real competition is not the other logistics companies in India, and we don't view them as such. We really view it as shifting share from unorganized to organized. That's where our competition is.
What are your views on acquisitions for now? Have everything that you acquired integrated well and you are putting a pause on acquisitions? Or are you still on the prowl with the 5,000 plus crore cash that you have on your books?
So acquisition for us is a choice in terms of two things. One is either it's a capability that we really want to sort of scale up ourselves. So as an example, we invested in a company called Algorithm, which extends our supply chain services suite. It provides inventory management software, for example, which is useful to our clients. Or Vinculum, where we own 10%, which enhances our direct-to-consumer value proposition. So that's a capability acquisition. Those are typically small acquisitions. We will typically try to take, ideally we'll take a majority stake or less if we feel it's, good for us. Or there's something like Falcon, which is the system that you see here is done by this company called Falcon Autotech, with a majority shareholder. That's because this is a strategic capability for the future, right? This is core to how we do business, and so we will, back this company and make the acquisition. A spot-on-like acquisition is one which gives us scale in a new business line. So Part Truckload, Delivery and Spot-on getting together has effectively, from our position, tripled our volumes, compared to where we were 2 years ago. So we'll continue to look for acquisitions in these categories, but we're relatively selective. I don't know whether there are, let's put it this way. I don't know whether we're going to be very aggressively acquisitive over the next year or so. But if the right opportunities come along in any of these buckets, we keep looking at them and we'll make some of them. I think our focus will really be on tech capabilities, hardware, and in some cases, if we find the right scale acquisition opportunity, then we'll look at it.
But I don't know about the cash burn in new companies and all of that and stuff. There's definitely a lot of calorie burn given the sort of walking that takes place in places like these. But let's talk about cash burn itself. Should we say that incrementally now all the burn has stopped and now whatever business comes in will be cash flow accretive for you?
Yeah, I think if you look at our history of cash usage over time, a bulk of it has shifted away from funding operating losses, which we had to do when we started the network, towards capital in projects, building these facilities, buying trucks, or towards acquisitions. I think for us, the advantage is every incremental package that now comes in is highly profitable because we've already sunk these costs. And so over time, we don't think operating cash flows, will continue to suffer. I think we will continue to invest in building capacity, but from an operational standpoint, we'll be profitable.
It's been a little over a year that you've been listed on the bourses. What has being a public company so far taught you?
For us, to be honest, we found that running a public company actually is easier than running a private company in some ways. The biggest message for us has really been, on a regular basis, being able to communicate to a wide group of investors, a very wide group of investors, exactly what our strategy is. So it's forced us to really think about elements that we perhaps in the past had not explained as well. Go out and explain to people why building these kinds of facilities, why buying trucks is important. So our communication's gotten sharper. Our discipline in terms of meeting our quarterly numbers has gotten sharper for sure. We're better at forecasting, which is important in our business.
There is a bevy of PE investors who are looking to, perhaps offload their holding in the company. How do you manage that, or how do you go through those troubles when it has an impact on your share price?
Look, I think our job as the management team really is to build a great company, and that's what we're trying to do, really, right? Some investors will like the story and will buy in. I think there are enough people who we feel are interested in investing in, India's largest logistics company. And our PE investors ultimately, as their horizons end, they may sell the stock at times that they deem fit. We can't do much about it. So we don't think about it too much because it's not something we can control on a regular basis. The share price, how they decide their investment strategies, these are not things that we allow to influence our decision making about the business.
Your father's a finance professor. He watches a lot of CNBC-TV18. So the price of delivery, it was offered at a little under 500. Thereafter, it zoomed to a little under 700. Now, as we speak, a little under 400. Those sort of gyrations that we see, how do you keep yourself immune from that? And be honest, that would have affected you at some point, right?
Yeah, look, it's an emotional shock, of course, when you go public. As a private company, you're not used to seeing your company's price go up and down. And of course, it's an emotional shock, right? When the company's price went up, obviously, at that point, we were ecstatic. And then it went down and we were wondering what happened. But as with all things in life, you make your peace with it and you say, look, I'll focus on what I can control. And since you brought up my father, I think one of the things he taught me is that the value of something and the price of something are not always the same. We believe there's value in what we're building, and I think the price over time will reflect that.
So you're sure of the value that Delhivery has to offer,
Yes, we are.
even at the market cap that it currently has, and the potential that there is a lot more. SoftBank wants to exit in the company.
So
if there is what do you say, value in it, would you then look at people or would you prop up some other investors around you to go ahead and perhaps purchase that stake?
I think my job is to do the best I can to communicate our strategy, and the investor's job is to decide whether they want to invest or not. So I go out, we meet investors, we tell them what we're doing. We explain to them India's a large market, somebody's going to build a large logistics company. We think we're in pole position. Hopefully they'll invest.
I was reading a report where Amazon's captive logistics is actually a lot bigger than some of the largest logistics players in the world. Case in point, something like FedEx or UPS in terms of parcels delivered. Do you think that there is a threat like that which looms in India? How do we view that?
I don't. I think the circumstances of the US market are very different from the Indian market. I think Amazon runs a successful self-logistics business in India as well. But we're very confident that the cost of self-logistics is significantly higher than the cost of third-party networks in general, and certainly higher than the cost at which we serve these same clients. So first of all, if you're a third-party shipper and not Amazon yourself, Delhivery offers a competitive service. We're cheaper. We get everywhere in the country. We're exactly as reliable or faster, in fact, in some locations than an Amazon. And the last bit really is, we've spoken about this in the past. In the US, I think, and wherever logistics companies have failed to pass on efficiencies to their customers, that is a profit margin that ultimately a captive will go and attack. Right? Amazon's effectively saying, I can do this cheaper than you can. In India, we don't believe that's true.
So in that case, how do you view your yields over a period of time? What have they typically been like? And how do you intend that they go forward, given the efficiencies that you will be passing on to the customers?
See, we will continue to pass on these efficiencies based on the scale that we acquire over time, and obviously the operating efficiencies that we engineer through our network. As an example, when we moved from using smaller truck formats to larger formats, the cost of trucking for us declined. Now, when the cost of trucking for us declined, we had two choices. One is keep the excess margin that we were generating, but ultimately we have to, for lack of a better word, reward our customers for rewarding us and trusting us, with their business. And so we went back and said, we become more efficient, and so we'll pass on these benefits to you over time. And that's the way everybody wins.
So you would obviously chase customer growth more than keeping the overall margins that you will get off all the scale. Is that a strategy?
In India, for the foreseeable future, that is what is required.
So in that case, how do the 16-18% sort of margins come about?
We're not unprofitable when we pass this on. Remember that we pass on price benefits after our cost advantages come in. And we're already profitable on a unit basis on all of the parcels and all of the freight that we deliver.
The last 5 years, your revenue CAGR has been around 45%. The first half of this year, of course, given the circumstances, soft at around 8% odd. Do you, what do you see as growth, sustainable growth for your revenue?
I think you have to break it up, right? When you look at our business, first of all, about half our revenue comes from the e-commerce segment. In general, if you take the assumption that e-commerce will grow anywhere from 15 to 20% a year for the foreseeable future, let's say the midterm, I think Delhivery will grow our e-commerce business at least at that pace, if not faster than that. Because ultimately we'll either maintain market share or we'll grow market share. On the PTL side, I think our growth has been slower because we were digesting our acquisition of Spot On. So we were trying to make sure that we get all of the operational integration right. There were customers to be spoken to as we transitioned them. And so building that base has taken us 5 or 6 quarters. Now going from here, we have a solid base. I think now we'll go out and really attack the market and try to grow the PTL business much faster. How fast can we grow? I don't know. As an example, our PTL business has grown 23% year on year. Right? Now, our aim obviously internally is aggressive growth. Like I said, in 3 years, we want to be 10% of the market. Today, we're very small and insignificant. And that will translate to a pretty large double-digit sort of overall growth rate. And all of our other businesses, supply chain services, FTL, cross-border, these will be somewhat more opportunistic. There's a large space for us to grow into, and we will show large growth in these segments, but it's hard to predict exactly what that will be.
You are a fitness enthusiast. What does, being a triathlete or being in the fitness discipline teach you about business? What inspirations do you take from there?
The thing they say about running is that the hardest part is putting on your shoes. Once you start, it's all easy. I think what it's taught me really, and more people in the company really, we're a fitness addicted company in some ways, is that really the hard part is getting started, right? And after you get started as a company, our logic's simple: don't quit, right? I think India is a long game. Building a company of our size with our vision is going to take time. It's going to take patience. There will be ups and downs. We've had ours. And you just have to stay patient, stay the course, drive straight. And that's what we're trying to do. So stay to the straight and narrow, don't look around, run hard, put your shoes on. I guess that's what we've learned.
Of all the companies that came to the street around you as well, what have you learned from their journeys and what is it that you respect about them?
I think the biggest thing with Zomato that you have to respect is they were the first company to go public in some senses. They showed the way. Courageous move, they went public. And Dipinder has talked about the challenges of navigating that period. There's a lot to learn from how they've gone public. I think the manner in which they've chosen to communicate the Zomato story, the way they've made decisions in the last 2 years has been fantastic. And so we do look at them and say, look, what do we need to learn from the guys who came before us? You learn also equivalently from someone like a Nykaa who had, a breakout listing. They've managed being a public company wonderfully. And so we look at the management team, we look at the experience that Mrs. Nair has and say, look, what can we learn from her, the way she manages investors, the way she communicates the story. Yeah, but otherwise, to be honest, every company writes its own story, right? And so will we.
And outside of work, what are the other things that you like dabbling in? Is there any startup that you wish to invest in? Is that something that you do?
Not very actively, to be honest. I work and then I have triathlon, which is 14 hours a week, right? So that doesn't leave me with much time for anything else.
That's wonderful. We won't take much of your time, Sai. This has been a pleasure.
Lovely to meet you.
Thank you so much.
Thanks.